Imagine it's October 2008. You're a 58-year-old manufacturing supervisor in Cleveland, Ohio. You've worked the same plant for 31 years. You've contributed to your 401k every paycheck since 1987. You did everything the financial advisors told you to do. Diversify, stay invested, think long term. Your statement arrives in the mail. You open it slowly, knowing what you're about to see. In 11 months, your retirement portfolio has lost 43% of its value, but $312,000 have evaporated. You're 7 years from retirement, maybe 12 now. You sit at the kitchen table. Your wife doesn't say anything. You care about the 31 years of overtime shifts, the weekends you didn't take, the vacations you postponed. You wonder if you did something wrong. Here's the uncomfortable truth. You didn't do anything wrong, but you also didn't understand what you were actually invested in. You owned the popular assets, the ones that look spectacular during bull markets and catastrophic during contractions. But across town, there was another man, same age, same income, same career. His portfolio was down 11%. He didn't panic. He didn't call his broker. He didn't change his retirement date. Now, the difference wasn't luck. It wasn't timing. It wasn't insider knowledge. The difference was understanding one fundamental principle that most investors never learn. Recessions don't destroy wealth randomly. They destroy wealth predictably. And certain assets, by their very structural nature, resist that destruction every single time. This isn't theory. It's documented history across 14 recessions in the United States alone. Once you see the pattern, you can't unsee it. Most people believe that surviving a recession requires either perfect timing or divine luck. They think you need to sell at the peak, wait for the bottom, then buy back in. This is the mythology of market timing. Here is what actually happens. The average retail investor, according to Dalbar's quantitative analysis of investor behavior, underperforms the S&P 500 by approximately 4.3% annually over 30-year periods. Not because they choose bad stocks, but because they panic at bottoms and chase returns at peaks. They buy enthusiasm, they sell fear. But some investors don't follow this pattern, not because they're emotionally superior, but because they own assets that don't trigger the panic response in the first place, assets that decline less severely, assets that continue paying income throughout the contraction. These are not exotic instruments. They're not hedge fund strategies. They're boring, they're quiet, they're overlooked during every bull market, and they survive every single time. Let me show you exactly what survives and why. Investment 1, consumer staples. The first category is consumer staples. This includes companies that manufacture essential household products: toothpaste, laundry detergent, toilet paper, breakfast cereal, basic personal hygiene products. These are not exciting businesses. They don't double in value during technology booms. Hedge fund managers don't brag about their positions in dish soap manufacturers. But here is what they do. During the 2008 financial crisis, the S&P 500 declined 56.8% from peak to trough. The Consumer Staples Select Sector Index declined 28.5%, exactly half. During the 2001 dot-com collapse, the S&P 500 fell 49.1%. Consumer staples fell 9.4%. During the 1990 recession, the S&P 500 declined 19.9%. Consumer staples declined 5.2%. This pattern holds across every recorded recession in modern market history. The mechanism is simple. When a recession hits, consumers don't stop eating. They don't stop brushing their teeth. They don't stop washing their clothes. These behaviors are non-negotiable. What consumers do stop doing is buying luxury goods, vacations, new cars, restaurant meals, premium electronics. Consumer staples companies sell necessities. Their demand curve is what economists call inelastic. You might switch from name brand to store brand, but you don't stop entirely. Consider Procter & Gamble during the Great Recession. In fiscal year 2008, they generated $83.5 billion in revenue. In fiscal year 2009, at the absolute nadir of the crisis, they generated $79.0 billion, a decline of 5.4%. Compare this to General Motors. In 2008, they generated $148.9 billion. In 2009, they generated $104.6 billion, a decline of 29.7%. And they required government bailout to survive. Same recession, radically different outcomes. The difference is structural. It's about what the company sells and whether people can stop buying it. Consumer staples also pay consistent dividends through World War I, through the Great Depression, through every recession since. When your portfolio generates income during a downturn, you don't need to sell shares at depressed prices to meet expenses. This eliminates one of the primary mechanisms by which recessions permanently destroy wealth. Think about what that means. Investment 2, utilities. The second category is utilities. Electric companies, water providers, natural gas distributors, the infrastructure that keeps modern civilization operational. During the 2008 crisis, the utilities select sector index declined 39.9%. Still painful, but significantly less than the 56.8% decline in the broader market. During the 2001 recession, utilities actually gained 5.2%, while the broader market collapsed 49%. The mechanism here is similar to consumer staples, but with an additional structural advantage. Utilities are regulated monopolies. In most jurisdictions, a single company holds the franchise to deliver electricity or water to a geographic area. You cannot choose a different electric company. There is no competition. The company has a guaranteed customer base that cannot leave. Furthermore, utility rates are typically set by public utility commissions. These commissions allow utilities to earn a predetermined return on their invested capital. This is not capitalism in the traditional sense. This is a regulated compact. People still need electricity during recessions. They still need water. They still need heating. These are not optional. Even in severe economic contractions, utility usage declines only marginally. Consider Duke Energy during the Great Recession. In 2007, they generated $12.7 billion in revenue. In 2009, they generated $12.7 billion. No decline through the worst economic contraction since the Great Depression. This isn't brilliance. This is structure. Utilities also traditionally pay high dividends. Dividend yields of 3.5 to 5% are common. Southern Company has increased its dividend for 22 consecutive years. Consolidated Edison has paid dividends for over 100 years. When the market is falling 40% and your utility stocks are falling 28% while still paying you 4% annually in cash, you experience the recession differently. You have income, you have stability, you have time. Time is the most undervalued asset in recession survival. Investment 3, healthcare. The third category is healthcare. This includes pharmaceutical companies, medical device manufacturers, healthcare facilities, and insurance providers. During the 2008 crisis, the Healthcare Select Sector Index declined 38.5%, compared to financial stocks declining 83%, or consumer discretionary declining 59%, healthcare held together. During the 2001 recession, healthcare actually gained 4.3%, while the broader market collapsed. The mechanism is brutally simple. People get sick during recessions. They get cancer. They have heart attacks. They need insulin. Economic conditions do not pause biological reality. Pharmaceutical companies that manufacture essential medications operate in a uniquely protected position. A diabetic cannot decide to stop taking insulin because the stock market declined. A cancer patient cannot postpone chemotherapy until the recession ends. Healthcare has additional structural protections, patents. A pharmaceutical company that develops a successful drug typically holds patent protection for 20 years. During this period, no competitor can manufacture the same molecule. The company has a legal monopoly on a product that people need to survive. Consider insulin. 3 companies control approximately 90% of the global insulin market: Eli Lilly, Novo Nordisk, and Sanofi. During the 2008 crisis, all 3 maintained profitability. All 3 maintained dividends. All 3 recovered quickly. The constraint on their revenue isn't economic conditions, it's the number of diabetics in the world. And that number doesn't decline during recessions. Johnson & Johnson has increased its dividend for 61 consecutive years, through every recession since 1963, through wars, crises, pandemics, and financial collapses. They make Band-Aids. They make Tylenol. They make surgical equipment. None of these products become optional during economic contractions. This is the difference between cyclical and defensive sectors. Cyclical sectors rise and fall with economic conditions: automotive, housing, retail. Their revenues track GDP almost perfectly. Defensive sectors maintain revenues regardless of economic conditions. Their revenues are anchored by human necessity, not consumer confidence. Understanding this distinction is the difference between surviving recessions and being devastated by them. Investment 4, short-term Treasury bonds. The fourth category is United States Treasury bonds, specifically short-term and intermediate-term maturities. This is where many investors make critical errors. During recessions, equities typically decline. What is less understood is that high-quality government bonds typically appreciate during recessions. During the 2008 financial crisis, long-term Treasury bonds gained at 27.5%, while the S&P 500 lost 56.8%. During the 2001 recession, long-term Treasuries gained 13.4%, while stocks collapsed 49%. The mechanism is straightforward. When economic fear increases, investors sell risky assets and buy safe assets. The safest asset in the global financial system is United States Treasury debt. The U.S. government has never defaulted on its obligations. This creates a flight to safety dynamic. As money flows out of stocks and into treasuries, bond prices rise. During recessions, the Federal Reserve typically cuts interest rates. When rates fall, existing bonds paying higher rates become more valuable. Treasury bonds benefit from two tailwinds during recessions: flight to safety buying and Federal Reserve rate cuts. I'm not suggesting long-term Treasury bonds are always appropriate. They carry duration risk. What survives recessions most consistently is short-term Treasury exposure, bills and notes maturing in 1 to 5 years. These instruments have minimal duration risk and provide liquidity when you need it most. The constraint here is important to understand. Treasuries do not generate wealth. They preserve capital. They provide dry powder. They give you the ability to act when opportunities emerge at crisis prices. In 2008, the investor who held 30% of their portfolio in short-term treasuries had the ability to rebalance into equities at generational lows. The investor fully invested in stocks, watched helplessly, unable to act. Warren Buffett has famously maintained massive cash and treasury positions throughout his career, not because he expected low returns, but because he understood that opportunity arrives precisely when capital is scarcest. Berkshire Hathaway deployed $50 billion during the 2008 crisis, buying Goldman Sachs' preferred shares and other distressed assets. Those investments generated enormous returns precisely because they were made when everyone else was forced to sell. The Treasury allocation didn't generate those returns directly, but it enabled them. Investment 5, Dividend Aristocrats. The fifth category is a specific subset of stocks known as Dividend Aristocrats. These are companies in the S&P 500 that have increased their dividends every year for at least 25 consecutive years. Of the thousands of publicly traded companies in the United States, only 66 currently qualify. During the 2008 financial crisis, the S&P 500 Dividend Aristocrats Index declined 21.9%. The broader S&P 500 declined 37% on a total return basis. The outperformance is consistent but not dramatic during the crash itself. The real advantage emerges during recovery. Because these companies maintain and increase dividends through downturns, shareholders receive income that can be reinvested at depressed prices. When you reinvest a 3% dividend yield into stocks trading at 50% of their previous value, you're accumulating shares at an accelerated rate. When the recovery arrives, you own more shares than you did before the crash. Your recovery is amplified. But there's a more fundamental reason dividend aristocrats survive recessions: selection pressure. A company cannot increase its dividend for 25 consecutive years unless it possesses certain structural characteristics: stable cash flows, conservative financial management, products with persistent demand, management discipline. The dividend requirement forces these characteristics. If a company takes excessive debt, it cannot maintain dividend growth when interest costs rise during a recession. If a company sells purely discretionary products, revenues collapse and dividends must be cut. Consider what has happened over the past 50 years. Enron did not pay 25 consecutive years of increased dividends. Lehman Brothers did not. WorldCom did not. General Electric no longer qualifies. The dividend aristocrat screening would have excluded you from every major corporate catastrophe of the past generation. Coca-Cola has increased dividends for 61 consecutive years through the Vietnam War, stagflation, the dot-com bubble, the Great Recession, and the pandemic. 3M has increased dividends for 64 consecutive years. These are not exciting companies. They don't appear on CNBC discussing revolutionary technology. They don't trend on social media. They make soap, they make tape, they make soft drinks, and they survive every single time. Let me synthesize what we've observed. 5 categories: consumer staples, utilities, healthcare, short-term treasuries, dividend aristocrats. Each possesses the same fundamental characteristic: inelastic demand. Their products and services are not optional. They're anchored by necessity. The second pattern is income generation. All 5 categories either pay dividends or interest throughout economic contractions. This income reduces the need to sell shares at depressed prices. It provides capital for reinvestment. It creates psychological stability that prevents panic selling. Investors who receive regular income from their portfolios are dramatically less likely to sell during downturns. The income creates a sense of continued function. The portfolio is working. This prevents the catastrophic behavior that destroys most retail portfolios: the panic selling at the bottom, the crystallization of paper losses into permanent losses. The third pattern is leverage avoidance. Companies that survive recessions typically carry conservative debt levels. When recession hits, over-leveraged companies face a death spiral. Revenues decline. Interest costs remain fixed. Cash reserves deplete. Bankruptcy follows. Companies with conservative balance sheets simply wait. They have time. They survive until conditions improve. The 1973-1974 recession resulted in a 48.2% decline in the S&P 500. Consumer staples declined 23.4%. Utilities declined 19.8%. The defensive investor recovered in 2 years. The aggressive investor waited until 1982. The 2001 dot-com collapse saw the Nasdaq decline 78.4%. The S&P 500 declined 49.1%. Consumer staples declined 9.4%. Utilities gained 5.2%. Healthcare gained 4.3%. Treasury bonds gained 13.4%. An investor with a diversified defensive portfolio actually made money during the worst technology collapse in market history. The 2008 financial crisis saw the S&P 500 decline 56.8%. Financial stocks declined 83.1%, but consumer staples declined only 28.5%. Long-term treasuries gained 27.5%. A portfolio holding equal weights in staples, utilities, healthcare, and treasuries declined approximately 19% during the worst crisis in 80 years. The pattern is unbroken across 9 decades. Defensive assets don't prevent losses. They minimize losses. They maintain income. They preserve capital for recovery. This is where it breaks for most investors. They look at these categories during bull markets and see underperformance. Consumer staples returning 8% when growth stocks return 30%. They abandon the defensive positions. They chase the momentum. They concentrate in the winners. And then the recession arrives. The 30% gains in growth stocks become 60% losses. The 8% gains in staples become 20% losses. But by then, it's too late. The decision to abandon defensive positioning must be made before the crisis, when everything seems calm. Here is the constraint that makes this pattern inevitable. Recessions cannot be prevented. They can be delayed. They can be softened. But they cannot be eliminated from economic systems. The business cycle is inherent to capitalism. Credit expands. Malinvestment accumulates. Corrections occur. Since World War II, the United States has experienced 11 official recessions. That's one every 7 years on average. If recessions are inevitable, then recession survival is not optional. It's a fundamental requirement. Some investors argue that recessions don't matter for long-term holders, that if you simply hold through the downturn, you recover eventually. This is mathematically true, but practically false. The investor who watches their portfolio decline 50% doesn't remain calm. They panic, they sell, they lock in losses, they miss the recovery. Dalbar has documented this repeatedly. The average equity investor underperforms by over 4% annually because they sell at lows and buy at highs. Defensive positioning reduces the magnitude of losses. Reduced losses reduce panic. Reduced panic prevents destructive behavior. Prevented destructive behavior allows participation in recovery. The portfolio allocation is doing the emotional work that humans cannot do themselves. This is why boring works. This is why quiet works. Let me tell you who paid the price in 2008. The workers nearing retirement with aggressive portfolios. They lost 40% of their wealth within 7 years of needing it. Many postponed retirement. Some never recovered. The retirees drawing down aggressive portfolios. They were forced to sell shares at depressed prices to fund living expenses. Each sale locked in losses. Their portfolios never recovered, even as the market did. The panic sellers. They sold near the bottom, waited too long to reinvest, and missed the recovery. Many never returned to equities. None of these people made obviously wrong decisions before the crisis. They followed conventional advice. What they didn't understand was the difference between theoretical resilience and practical resilience. In theory, they could hold through a 50% decline. In practice, they couldn't. The defensive investor didn't require superhuman emotional control. Their portfolio only declined 20%. Their dividends continued. They had capital to redeploy. They survived because their portfolio was designed for the reality of human psychology, not the fiction of rational economic actors. I'm not going to predict when the next recession occurs. What I will tell you is this. The United States has experienced economic expansion for the majority of years since 2009. Investors who began their journey after 2008 have experienced one significant downturn in 2020, which lasted approximately 5 weeks before unprecedented intervention arrested the decline. This has created an investor cohort that has never experienced a sustained bear market. They've never felt the psychological pressure that forces capitulation. They own concentrated positions in growth stocks. They use leverage through options and margin. They dismiss defensive sectors as old-fashioned relics. They may be right for years, but history does not repeat. It rhymes. And every generation of aggressive investors eventually meets their recession. Some survive, most don't. The question isn't whether defensive positioning will matter. The question is whether you implement it before you need it. This is historical and educational analysis. It is not financial or investment advice. Past performance does not guarantee future results. Consult qualified financial professionals before making investment decisions. No investment strategy eliminates risk. Let me return to Cleveland in October 2008. 2 men. Same age, same income, same career. Different outcomes. One owned the popular investments, the ones that looked spectacular during the bull market. The other owned the quiet investments, the boring ones, the ones that generated modest returns during good times and modest losses during bad times. When the crisis came, one man's retirement was destroyed. The other man's retirement was delayed by perhaps 18 months. The difference was understanding that survival matters more than optimization, that the goal isn't maximum returns. The goal is completing the journey. Consumer staples, utilities, healthcare, Treasury bonds, dividend aristocrats. None of these will make you rich during the next technology boom. None of these will trend on social media, but they survive. Every recession, every crisis, every panic, they survive. And for the investor who understands that the journey includes inevitable downturns, survival isn't the floor of the strategy. Survival is the strategy. The pattern is already documented. The evidence spans 90 years. The mechanism is structural, not speculative. Most investors will ignore this until it's too late. They'll chase the momentum, they'll concentrate in the winners, and then the recession will arrive. It always does. This channel tracks the patterns that most investors discover too late. If understanding financial history before it repeats matters to you, consider subscribing. The next recession isn't a prediction. It's a certainty with an uncertain date. The only question is whether you're structured to survive it.